Welcome back to the program. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. So my name is Kristin Castello. I am joined here with Chet Cowart. Before the break, we were talking about alternative investments that are now going to be potentially available within your 401k options. So Chet, kind of recap us on the investment that Joel had made that you talked about on a previous show.
Yeah, so long story short, the current administration has signed an executive order. Basically what they're trying to do is bring alternative investments as available options in your employer retirement plan. So think private equity, cryptocurrency, that sort of thing. I think people have been asking for this for a long time. Those investments are seen as sort of the the investments for the wealthy, the powerful, what can beat the market, maybe what can just offer you outsized returns, and in some cases that can be true. Obviously everything is a risk reward argument. The potential for huge returns are there, but that isn't always the case, and a good way to highlight that is a story from Joel himself. So this was actually a few years ago when he did it, but we talked about it on the show a few months ago. Essentially what he did was he invested a sum of money into a private equity fund that invests in real estate. And the reason was because the advertisement said that the internal rate of return was well over 10% over a long-term basis. So that sounds really good. But we have to remember, IRR, that means internal rate of return. That is what the assets within the fund return on a pre-fee, pre-expense basis. And then at the end of the day, what really happened is when we calculated his personal return after all of those fees and expenses, that happened to be closer to about 5%. So that ends up being the issue, is that with these private funds, the expenses are a lot higher because there's a lot more active trading. You have to pay managers a little bit more because they're a little bit more hands-on. So yeah, I mean, that I guess is the fear here, is that when and if those investments become options in your 401k, it may drag performance, it may cause liquidity issues to the investor. And, I think it is important to also think who is passing these rules and trying to get this, get this into your plan. You got to think what their motivation may be. I think for these managers, more retail money and more liquidity in their funds, that's obviously what they're going to want. They want more retail money into their investments. So it may not be in your best interest. It may be in the fund manager's best interest.
Yeah, and I mean, after hearing that about Joel's experience, I think it's safe to say that we won't really be recommending any types of alternative investments anytime soon. Over here at our firm, at Nelson Financial Planning, we are definitely fans, of what we've seen work over long periods of time. So we only use funds with at least a 20-year track record because that shows reliability and consistency.
Yeah, no, absolutely. That's always been kind of our consensus, is use funds with a long-term track record, 20 years or more, in terms of performance metrics that we can look at and judge the fund based off of, as well as, we only recommend funds that we invest in ourselves as individuals and as a firm. So all of the funds that you guys, as our clients, will see in your portfolios are funds that we personally use as well for our retirement accounts.
Yeah, I think that's really important.
Yeah, no, absolutely. It kind of shows that, we believe what we're saying. We're putting our money where our mouth is, so to speak. So yeah.
Yeah. So if you have any questions about your 401k, or maybe you have the option to add in these alternative investments coming up, just give us a call. We offer free initial consultations. We're happy to take a look at those options within your 401k and just give some advice, some perspective into what may benefit you.
Right. So for the back half of this segment and into the next one, we're going to be talking about some changes coming to these 401k plans in terms of their catch-up contributions. So there's some big changes coming, especially if you are a high earner over the age of 50. So some background for our listeners: 401ks typically their contribution limit is $23,500, but they offer catch-up contributions for those age 50 and older. Those that amounts to $7,500 extra on a yearly basis. So previously, employees have the option to do pre-tax or Roth for their $7,500 catch-up contribution. And if you are age 60 to 63, which is a new rule, there's a super catch-up that increases that amount to $11,250. But now there's a new regulation. Have you heard about the new Roth rule?
Yep. There's been a lot of articles out there about it, a lot of news about it. It's causing quite a stir. It's actually not that new because it originated from the Secure Act passed back in 2022. But as always, the IRS took their time to finalize the rules on it. So it is just starting up in 2026. So what the new rule is if you are 50 and older and you are earning more than $145,000 of wages at your employer, your catch-up contributions to your 401k will have to be made into a Roth account. So that means you're going to be paying the taxes up front on those. So you won't be able to do your catch-up contributions as a pre-tax contribution anymore. So that's that $7,500 if you're age 50 and older, and then if you fall in that special catch-up bracket of ages 60 to 63, that amounts to $11,250.
So the IRS is mandating Roth savings, which means they get their cut up front. I'm not totally surprised by that, that they would want that. So what does this mean, for our clients and their strategy when it comes to retirement savings?
Great question. That's the question everybody wants answered. So the IRS just finished the rules, and for some, this is going to be a major shift. So imagine if you're 60, so you fall into that super catch-up bracket, and you are in the 35% bracket or potentially the 37% bracket, and you want to make a super catch-up contribution of that $11,250, you could lose a $4,000 tax benefit. So that's just taking the $11,250 times your tax bracket of 35%. That's a $4,000 difference. So that's pretty significant. And even with the contribution being Roth, that doesn't lower your income for tax purposes. So that could push your adjusted gross income into a higher tax bracket.
Right.
So some major implications from it if you don't kind of just take a look at it and plan ahead.
Yeah, no, that's definitely something to keep your eye on, especially if you're right on the cusp of another tax bracket. As we just talked about, the Roth contributions don't bring your income down on an immediate basis like the traditional contributions do. So there's a problem here because I see a lot of clients I talk to look at their 401k plans. They don't have a Roth option. So if that's the case, then what happens there?
That's a real possibility. So 401k plans are not required to offer the Roth option, though many are, just by virtue of it's a popular option. A lot of people want to do the Roth, so a lot of 401k plans are offering it now. But if your plan doesn't have a Roth option, you may not be able to do catch-up contributions at all if you fall into that high wage earner.
Mm-hmm. Yeah, I have seen more and more Roth options in plans recently just due to the popularity, but still on a relatively regular basis, see that as not an option. So that I would imagine this is going to push more employers to add the Roth option, right? It has to.
Oh, I'm sure. When high income earners are going to be shut out of their catch-up contributions in 2026, they'll complain, and I'm sure more plans will start offering that Roth option.
So if you're a self-employed high earner, what does this look like?
Yeah, so it turns out self-employed individuals are exempt from the new mandatory Roth catch-up for high earners. So this means if you own your own business and you are set up as like an S corporation or something along those lines where you're paying yourself wages and you establish a 401k for your business, so something like a solo 401k, you can continue making pre-tax catch-up contributions. So you are not required to make those catch-up contributions as Roth.
And who else is exempt?
Well, so there's another category that's sort of exempt. So the way that the wage limit works is it looks back at the previous year that you worked at that same employer. So if you are new at your job, that first year will kind of be a free pass for the Roth rule. So since we're looking back at the prior year wages, that means that technically the new employees can get a free pass for their first year.
So there's some exemptions, and there's some people that that may get screwed on this, we will certainly see. But we're going to dive a little bit more into this, as well as some options of what you can do with your 401k plan, whether you're still working or nearing retirement or even in retirement. So this has been Chet Cowart, Certified Financial Fiduciary with Nelson Financial Planning. Kristin Castello, also Certified Financial Fiduciary. We will be right back.